Recording in progress.
Good morning, good evening, good afternoon, and welcome to the 2022 Master Trader Program with Mark Minervini. My name is Bob Weissman. I'm your moderator for the weekend and do want to welcome you to day 3 of the event. Today's curriculum will be approximately 3 hours, 15, 20 minutes or so, and then we will have a live question and answer session with Mark and Mark as well. Any questions you do have regarding the curriculum from the first weekend, day 1 and 2, as well as today, can be emailed to me at bob@minervini.com. Please do not type questions into the chat box because they get lost very quickly and will not be able to be recovered to be asked. Today's attendance, of course, is strictly prohibiting any audio or video recordings and sharing of the information you are learning from Mark Minervini here today. Our event is sponsored by MarketSmith, by Investors Business Daily exclusively. They are our official sponsor, and brought to you by Minervini Private Access. So today we are going to start with failure reset. This is page 261 of technically volume 1. It's the last part of volume 1 that Mark still has to get through before we get into volume 2. And with that said, I will share with you, we'll have a few breaks after each of the sections today. So again, I believe we'll have 3 breaks during the curriculum portion. We'll take a break after the curriculum is over, and then we'll get started with the questions and answers after that. Also, as a reminder, a replay of today's session will be at 6 p.m. Eastern Time, New York time. It is with the exact same material from this morning that will be shown again this evening. And also the same links and log-on information is what you'll be using for all the sessions. Again, some people have asked me for new links. It'll be the same ones. If you're here already, of course, you're already in the room, but for tomorrow, day 4, as well as the live training day on Monday, November 21st, there will be additional questions and answers available on Monday during the live training day. But tomorrow, day 4 of the curriculum is purely curriculum, as it's an entire day event for that. Again, entire day meaning about 5 hours or so. We'll get more details of that tomorrow. But today's curriculum for day 3 starts on page 261. And with that said, let's get started with Mark and Mark.
Okay, everyone, welcome back. Day 3, 2022 Master Trader Program. Not seeing myself up in the video here, so I hope that I am actually recording. Can you see me, Mark?
I sure do.
Okay, great. Hope everyone else sees me. Real quick, our sponsor is MarketSmith. And just want to remind everyone, once again, on live trading day, we'll be doing a tutorial on MarketSmith. We'll have somebody here from MarketSmith. I think it's Scott St. Clair. And we'll be going over the MarketSmith product and how we use it. So just wanted to quickly point that out. Let's see here. So right now, we're going to talk about something that we call a failure reset. And that is where when you get into these chart patterns, these VCP patterns, sometimes you'll be early. And particularly, this is a really good time to talk about this because when you're in a bear market, you're in a correction, especially when you're in a large correction or a large bear market, you can get bear market rallies, you can get false signals, if you will, and sometimes you'll have these VCP patterns set up and they get tight on the right side, only to find out that they needed more work and that it was just the beginning of what needed to be a longer or have more contractions, or even sometimes some widening of the volatility and then a retightening. I'm going to show you that right here. So again, you start seeing these patterns. You're doing your screening, or maybe using MarketSmith, and you start seeing these patterns show up. We tend to get really excited when we start to see a bunch of VCP setting up, because that's a potential. Those are opportunities. And then when you set up that pivot right there, that tightest point in the right side that we refer to as the pivot, if you take out the low in that pivot, and sometimes you can break out and then you reverse and take it out, and sometimes you don't break out at all in a really weak market, we call that a pivot failure. And then what that does is that sort of reestablishes the count. So if you were to, let's just say this was 20%, this was 10%, and this was 5%, now it comes and takes that out. Well, maybe this is now 8 or 9%. However, as long as this is this pullback here is still in that single digit, you're still tightening up enough to just to be considered for purchase if it should turn around and then break out from there. So you have to do the math. You have to, it's real important that you're cognizant of the percentage declines and know exactly what's going on in that tightest portion. There's another thing that I forgot to point out before, and I want to I want to tell you about this right now, and that is that generally what we find is that when you get these pullbacks and these contractions, they usually they have themselves, and not always, but sometimes it's 1/3, 1/2. But generally speaking, you'll see like the first pullback might be 27%, the next one 16, 17, 18, the next one is maybe 8 or 10. They're usually about half of the previous decline, give or take. So that's just something to be aware of as you're watching this. They don't have to be, though. Okay, you can have, if this was a 10% decline and this was an 8 or 9, that would be, of course, a lot more than half of the previous decline, and that would still be fine. So what'll happen is a lot of times, and again, like I said, in a bear market, we'll have where you have some rallies off the lows, and sometimes you'll get a setup, and the market will either start rallying, and they'll get some stocks setting up, and they'll rally, they'll break out, or a few stocks will set up. You'll see a handful of stocks setting up, and then as the market goes to lower lows, the stock will experience a pivot failure, and it'll take out that low. But then when the market turns back up, you'll have these stocks will start to break out. And the main thing is you want to stay with the count, okay, and just keep making sure that that right side is tighter than the previous pullbacks, and that it's in that single digit range. Because once you get outside, you start getting to 12, 15%, 20%. That's just too much. That's too much volatility. It's too much risk. Now, and Mark, of course, this is something that you know a lot about, and you tend to, I've seen over the years, we call this a failure reset. You tend to play a lot of these failure resets. What's the trick to, spotting these things and then sticking with them and keeping that discipline of not getting, discouraged if those initial setups don't pan out?
Yeah, I think part of it is back to the point we talked about being weak holders. You want to think like a weak holder. And so, when you look at this is obviously the hypothetical, but when you look at that sort of little pivot leakage, that often knocks out a lot of weak holders, myself included, or Mark and myself will sometimes get knocked out of a stock, but you don't just give up on the name. Now you don't run right back in and buy it. And we'll get into the examples of how this works, but often that subsequent setup is even better because you've knocked out previous weak hands. Now you may have been a part of that shakeout, that we talk about, but that's okay because if the name comes back, it potentially shows that it is under institutional accumulation. Our timing might just been a little bit early.
Yeah, and what happens is as the stock goes through these iterations, you can actually get a much improved setup that takes a little bit more time. And those shakeouts that, just like Mark said, that shakes you out, you're a weak holder. It's also shaking out other weak holders. And that is, once again, letting the stock go through that natural progression of wringing out that water, once again, wringing out that supply. So sometimes, excuse me, sometimes you come down and you really get volatile, and it takes another tightening, and you might have to go through another tightening. And then from there, if you were, saying this is a 1, 2, 3 T, and now it takes out those lows, well, now it would be 1, 2, 3. And some people have said that this is sort of like Elliott wave. Not really, it's really nothing like Elliott wave. It's simply just, measuring the percentages and then looking for the tightenings to culminate to where on the right side, on the very right side, there's symmetry and there's enough tightness in price that you're not taking too much risk. And when we say taking too much risk, below that pivot point, below the base, those are the areas that should hold. Once the stock breaks out, those areas in a good market, and if the timing is right, you get everything right, those areas usually hold. So it's abnormal for the stock to get below those levels. So we want those levels to be mathematically acceptable. So these are the technical levels that we would maybe put our stops, but they're still within the confines of the prevailing math that we need. And so let me show you another. You can also get where maybe you have a larger correction, a much larger correction in the market, and you get a bunch of setups. We've seen this before where everything looks really good, and then it comes crashing down, and the market needs another big leg down, and it washes all the boats. Takes all boats with them, and now you come off and you undercut the lows in the base. That sometimes takes a lot longer to set a larger base, and then you have your other techniques. Now you might start looking for low cheats or cheats, and then it'll build a handle later on. So that's why we have these various points and levels to get on, like they showed you, the low cheat, the handle. That the reason why we have all these different levels is because it's very unlikely the stock could set up in a way where it comes out of a base and it's not going to at least give you either a pivot point breaking out to new highs, a low cheat, a cheat. Somewhere in that base you're going to get one of these or all of these setups, and that's the goal, is to have enough tools or tactics in your tool bag that you'll be able to get on board before the stock takes off. Now, I mentioned that almost all the stocks that I'm showing you here, a pretty good portion of them, up 95% of them, are all stocks that I traded. Doesn't mean that I traded them all successfully. This happens to be one that I traded unsuccessfully and turned out to be where I made the error of not re-entering on what we call a failure reset. So there's two kinds of resets. There's a failure reset, a failure pivot reset, and there's a failure base reset. The failure pivot reset is when you undercut the pivot, but not that much damage has been done. So you could reset pretty quickly, and sometimes you'll just get another little tightening. And this was, of course, Craft Brewers. I bought it right here, and it had this little, it squatted on the breakout and then came back in, and I actually got knocked out of it. But then shortly after, it was just a couple days later, it tightened up. And like I said before, it can improve. This was actually an improved setup because now you've shaken out more supply and you've tightened up really, really nice here. Look at the volume. It comes way down, and then you can see you got the 1-2 punch. You got the low volume and then a huge volume coming out, relatively huge volume at least, coming out in a really big breakout. And if you take a look here, one of the reasons why I studied this one is because I got knocked out of it. I missed the reset, and this is what happened in 26 days. I was standing on the launch pad watching the rocket from the ground and not enjoying the ride. So I you should always study the stocks that you make mistakes on, turn out to be big winners. Study them, find out, could you have gotten on board at some other point? So the failure reset is something that that we use, and it can happen sometimes in tumultuous environments where, and again, like, see, this could be a company that, the earnings, just because the stock goes down 5%, 6%, 8%, that doesn't mean that the company all of a sudden is doing poorly and they're not earning money and the business isn't doing well. But see, we have to manage, and why don't you talk about this, Mark? Why is it that if the company's doing so well and we see the earnings and everything's great, then why would we sell if the stock just went down a little bit? Why not buy more or just hold the stock and go through that? Why sell it 7 or 8%? Why would we cut our loss?
Well, I mean, in terms of, are we talking on risk protection mode?
Yeah. Why would,
yeah. Well, the short answer is risk of ruin, of course. We're never let a losing trade turn into an investment. That's one of the worst things. But look, the reality is, like we showed in a lot of these previous examples, how many of these topped while the story still looked great, and the earnings were, they might have still been triple digit even, but it's already been priced in because the market is, again, it's discounting the future. So we don't, I've heard Mark say this many times, but every 50% decline starts as a